most fund managers will talk about their competitive advantage, whether it's real or not. So the other thing, I suppose a couple of things for us we think distinguish ourselves. Firstly, that we are genuine large cap managers. So 80% of the portfolio is ASX 50 with a maximum of 20% in the 51 to 100. And the reason we've done that is just to ensure that we can specialise and build our knowledge of not only the companies that we own, but the companies that we don't own. So, in our view, that a lot of people tend to focus solely on the portfolio they already have, whereas your next best idea is actually coming from the businesses you don't own. Secondly, that value growth, so style neutral approach, really means we ride through most market cycles. There'll be periods where we might have more value in the portfolio or more growth in the portfolio, depending on relative valuations. We don't think that we should be talking about either or. It's really about the relative return that we're receiving. How much are we paying for a business versus its growth, and that certainly comes through in our performance over a long period of time. I'd be more the bullish one in the team at the moment. I think obviously direction is difficult in the shorter term. So if we look at particularly COVID and say the effectiveness of the vaccine that we're starting to come through now is really providing some direction to markets. So how that goes over the next 6 months is difficult. But for us, over the next 3 years, which is our investment time horizon, when we're buying a business, it's a minimum of 3 years when we're looking at it. For us, that's fairly clear that we won't be operating in this sort of COVID environment then. And so if we put that into context, then there's potentially a lot of opportunities, particularly in some of the businesses that are more COVID challenged. Probably the other side is just the supportive environment. If we look at the amount of money, fiscal stimulus, the amount of monetary policy support that's going in to the economy and how that affects asset values more broadly, we think that relative valuation support is also supportive of equities as well as other asset classes like property. Yeah, I think if you're looking at sector, you have to look at the COVID influence in the short term versus that 3-year time horizon. You have to also look at that macro support and then relative performance. If we look at last year, most of the performance in the market came from technology and from materials, particularly the iron ore producers, BHP and Rio and Fortescue. So very concentrated performance over that period of time, to a lesser degree, consumer discretionary. So for us going forward, one, that there's valuation concerns there, whether there's valuation support in some of those sectors, and whether those beneficiaries of COVID, it's harder for them to perform as well given the very high base of earnings going into, say, 21, 22. So we are positioning more for those recovery businesses. We think it's an easier ride coming out for them, and expectations for the market are very low, and so that's where we'll be positioning. So things like industrials, financials, to a lesser degree, say energy, and some selective consumer discretionary, depending on the composition of retail. So there will be some change in retail behaviour and household behaviour, we think, as well. So that's going to influence consumption patterns and sector performances. So that's how we're positioned at the moment. If you're looking for a recovery to travel consumption, we think it's best to go to the highest quality business in that sector, and we think that is Sydney Airports, given its monopoly position. Monopoly, 80% EBITDA margins, good diversification across revenue. So if we look at their aeronautical, they've done a lot to expand around the airport in terms of property, retail, parking. So we've got a lot of revenue contributors coming through, so good diversification there as well. And as I said, we're pretty reasonable in terms of expectations of recovery of both domestic and international passenger numbers, domestic first, but really not back to where we were until 22, 23. But over that period of time, we think that the stock is offering close to a 20% compound return as we recover. and we look at that sort of period, we'll be back to similar distributions to we were in 19 when Sydney Airport was trading around $9. So, that's for us the clearest way to, and probably the safest way on the downside, to look at this shift in consumption of the consumer and business back to travel. I think it goes back to maybe what my view as an investor and what I'd bring to the team is more as a business person, I think, rather than necessarily an investor. So looking at buying businesses, and from that very much focused on strategy, execution. What is the strategy and how well are they executing? For us, that is Macquarie, would be a very good example, Macquarie Group. Over the last 10 years, there's been a lot of market noise and people have, being in and out of Macquarie for various reasons due to that. But if you look at the broader strategy for that business over the last 10 years, they have dramatically improved the quality of that business. So if we look at 10 years ago, they had the same number of employees, and as they moved to more annuity income, more assets under management, they've improved the operating earnings of that business and the annuity part of that business. So, for example, if we look at things like assets under management per employee, they had something like 20 million. 10 years ago, it's now 40 million. If we look at operating earnings for the same number of people, from $80,000 of pre-tax earnings per employee to now $220,000 of pre-tax earnings per employee, that's meant much higher margins, much higher return on equity. There's sort of mid-double digits return on equity versus single digits 10 years ago. So we think that the market's really not seen so much of that, and we would actually view that potentially that business is slightly underrated in terms of its multiple as well, given the higher return on equity and the higher quality of that business and how they've been able to successfully execute that strategy. So that would be one. Longer term, that people are very focused in on short term when it comes to Macquarie, and sort of missing that longer term strategic picture.